All right, now all of that uncertainty is filtering through into the psyche of fund managers as well. This word of caution from Bank of America, Merrill Lynch came out in their latest fund manager survey, which was conducted by the brokerage house. That survey paints a grim picture. In fact, 230 of the world's largest fund managers are the most bearish since the global financial crisis. Niraj Shah gives us the highlights of that survey.
Yeah, well, that's right. It's the Bank of America Merrill Lynch Global Fund Manager Survey, and it is the most bearish survey since the global financial crisis. So that speaks volumes about what fund managers, mainly in the predominantly the US markets, but across the world, might be feeling. And remember, I mean, as we all know, when the US sneezes, the world catches cold. So maybe that's why this survey is important from our viewers' perspective as well. So what is the survey saying? It's why the pessimism? Well, amongst the many reasons, the pessimism is driven by concerns over trade war concerns, possible recession driven predominantly by the trade war or other factors, and what they call the monetary policy importance, essentially in the US market. So pertinent to talk about it, considering it's happening a day before the monetary policy outcome is coming. So these are the principal reasons why this has happened. They, of course, also go on to say that there is a tactical pain trade if the higher yields and higher stocks, especially if the Fed were to cut rates in the policy today. Now, the different facets which they have highlighted. Firstly, cash. So they are saying that fund managers across the spectrum are cash bulls right now. They believe the cash is king, because if you look at the jump in the cash levels in the month gone by, it's the biggest month-on-month jump in the fund manager survey cash levels since August 2011. And that's quite a bit of reversal to cash from the fund manager side. So that is part one. Part two is they are equity bears, because the equity allocation has seen the second largest drop in equity allocation. It is the largest ever since August 2011, of course, but the second largest drop in equity allocation since a really long time. And that speaks volumes. The relative reallocation of equities over bonds has dropped to the lowest level since May 2009. But predominantly, I think it's stemming from the fund managers by and large being macro bears. They are very, very skeptical about what the macros are looking like for the US market. So the global growth expectations, most of them have lost faith. Look at this. This is a chart which shows what the expectations of the fund managers are with regards to global growth, and it's the sharp drop that has come into global growth expectations from a large degree of the fund managers surveyed by Merrill Lynch. This is, of course, it's the largest amount since November 1994 fund manager survey. They've been doing this for a really long time, but from that point of time, this is the biggest drop in global growth expectations, and the second biggest drop in earnings per share expectations by the fund managers as well. But the beauty is, in a nutshell, if you were to pick out what they are trying to say, a couple of things. One, that there is a bit of a crowded trade phenomenon that is playing out, and predominantly in two things. One is the dollar overvaluation, which Bank of America Merrill Lynch believes fund managers have right now. That overvaluation is the highest since 2002. So you got to watch out for that. And there is a bit of a crowded trade when it's coming to punishing equities simply because of the number of people that are turning away from equities. But if we can show one of the exhibits that's a part of the report, which shows where the fund managers are taking a bullish and a bearish bet. Now, obviously, this is the mean, the overweight and the underweight, and how they have gone ahead. So the defensive plays have clearly taken overweight. So staples, utilities, bond, and cash, those have seen significant increase in allocations. Cash, of course, not the top, because fund managers by nature will not really sit on too much of cash. The investors won't allow it, but still a high proportion of cash piling. And what's gone down is cyclical plays. Interestingly, also technology out here. So technology, not the highest reversal in positioning, but technology out there. Banks and equities by and large have seen the most dramatic lower allocation or lowering of allocation when it comes to fund managers. So two things that stood out for me: one, the bearishness with regards to the global macro and thereby equities, and the higher proportion of cash, which has been at the highest level since a really long time. These are the findings of the Bank of America Merrill Lynch Fund Manager Survey.